Hi, this is Stuart Weems and welcome to the Investopoly podcast. My goal is to give you simple, easy to understand strategies, insights and tips to help you master the game of building wealth. And in this episode, I'd like to talk about interest rate discounts, so mortgage interest rate discounts. And it's true that really new customers have always typically been offered better deals than existing customers. When was the last time your bank called you up and said, would you like a higher interest rate discount? It's never going to happen. But it's noteworthy that special interest rate discounts have increased over the last 10 years, which means the chance of an existing borrower paying a higher interest rate than a new borrower is much higher than what it was, say, 10 years ago. Now, when I say special interest rate discounts, most banks will advertise packages that provide for discounts off the standard variable rate, depending on, your loan size and maybe other factors and so forth. But when we go to negotiate discounts with lenders, we're almost always going to get a discount that's higher than the advertised rate. And over the last period of time, let's say 5 years, these special discounts have just been increasing and increasing. So it just shows that new borrowers are getting better and better deals, which means that existing borrowers are paying, by comparison, higher and higher interest rates. A decade ago, your typical average discount might range between 0.7 and, say, 0.9 of 1%. It was rare to get a discount more than 1% 10 years ago. Last week, we got a discount of 2.95 off the standard variable for a client, so nearly 3% off. So it shows 10 years ago, if you thought you got a good deal, it could be that you're paying 2% more just by not renegotiating your interest rate discount. In fact, the RBA has started compiling this level of data over the last few years, and I've got a chart on the blog on the website, and of course there's a link in the show notes, but it shows that the average interest rate to existing versus new borrowers, and the gap is widening on that data, and that's macro data, right? So it's not really going to capture the full impact, I don't think, of the disparity between what existing borrowers are paying and what new borrowers are paying. I think it's really meaningful to have a discussion of what's driving these interest rate discounts, because we can always point to overall competition in the mortgage market, but it's a little bit more than that. Now, it won't surprise you that management, so key management personnel in the bank, are remunerated on a number of different things, and a lot of it can be linked towards shareholder return, which is obviously driven to a large extent by the share price. Now, because retail banking, is really the economic engines within the banks, they contribute the lion's share of profit and revenue. There's two things that the share market will look at. They'll look at the growth in the mortgage book compared to what they call system, which is the general market growth. So is a bank's mortgage book increasing or decreasing, and is it increasing at a faster or slower pace than its peers? And the second thing they're going to look at is what's called the net interest rate margin, which is essentially really the bank's gross profit, how much they're borrowing funds for versus how much they're lending funds for. And you're looking for a net interest rate margin around 2%. Typically, that's their gross profit on mortgages. So these factors will have an impact on shareholder performance or shareholder returns, and therefore have an impact on management remuneration packages. So these are the things that bankers are going to start thinking about, looking at levers to pull and change in order to optimize those criteria or KPIs. So, for example, if a bank is falling behind in terms of mortgage book growth, you can really almost bet the farm on the fact that they're going to come out in the next quarter or half and be a little bit more aggressive in terms of new pricing for new mortgages, to try and sort of buy back some of that market share that they're losing. Because if they don't do that, the share market's going to really punish them because they're obviously losing too much market share to other banks. And a good example of that, it was in May, Westpac came out and said it experienced in its update, half-yearly update, it experienced a decline of 6.6% between September 2020 and March 2022. So that's a 6.6 decline in their mortgage book. Whereas if you look at their competitor like CBA, for example, it maintained its mortgage book through that period. So really, by comparison, Westpac has underperformed. So it's not surprising then that Westpac is at the moment one of the banks that are offering the highest discounts to win new customers. Now, all banks are going to ebb and flow between being less aggressive and more aggressive. At the moment, for example, ANZ has been struggling with its back office, but once its turnaround times, once it sorts that out, I expect that ANZ is going to come out with some pretty aggressive pricing. And once again, it's going to test their back office, and they might end up being out of control again, and they'll come out of the market. So these things ebb and flow, and it's really important to, I guess, understand what where banks are sitting in order to negotiate those better interest rate discounts. And because you've got to keep on top of it all the time, we at ProSolution have implemented an artificial intelligence tool that periodically reprices our clients' mortgages. So using a range of different data, it calculates, what sort of variable rates our clients should be paying, and then automatically submits a pricing request or approval to the bank to match that pricing. And it just works along behind the scenes in order to do that. Sometimes there's forms to sign which will generate and so forth, but it really makes sure that we're constantly running the ruler over the interest rates that our clients are paying, and making sure that they're not materially more than what's being offered to new borrowers. Now, of course, to do that manually is a very time-consuming exercise, so technology has made that a lot easier, and I'm sure with the emergence of the fintech market that similar sort of products and platforms will be available to borrowers. So if your mortgage broker isn't using something like that, then maybe you can. Okay, so let's talk about the situation where your mortgage broker doesn't use a platform like that, or isn't manually reviewing your interest rates. You need to do that yourself, and you need to do that periodically. I would say every 6 to 18 months. So in order to do that, what you need to do is first research which lenders are going to offer you the highest discounts. And unfortunately, it's not as basic or simple as just going, okay, how much can I borrow, or how much my loan amounts are, and therefore what should the interest rate be. Interest rate discounts are influenced by a number of different things, including loan-to-value ratio, total amount of lending, the number of individual loan accounts you might have, whether you have any existing fixed interest rates, whether your repayments are structured as principal interest or interest only, whether you have a home or investment loan, so different type of product there, the amount that you have in the offset account, and so on. So it's not as simple as just going, okay, here's my loan amount, what interest rate? It's got to be a little bit deeper than that. And of course, when you go back to your existing bank and you quote a competitor offer, they're going to check it out. They're going to make sure that it's reasonable. So you need to do that research, and whether you can speak to your mortgage broker, or in fact get a mortgage broker to do it for you. I can't imagine why anyone would want to deal directly with lenders these days. But anyway, that's the way to do it. Once you're armed with those details, it's as simple as making a call. And what you need to do is ask for the retention team. So it's a team that's just there to retain existing customers. And once you get on the line with them, essentially what you need to tell them is that you've decided to refinance to get a lower interest rate. You're just about to sign the discharge authority, which is a piece of paper that you normally have to sign just before you refinance. And you wanted to call them to see if there's anything they can do. Now, it's important to put it in this context so the bank knows that you're an at-risk customer. That if they don't match the discount, they're going to lose your business. Rather than diddly-daddling around with, a different way to say, can I please have a higher interest rate discount? Just tell them you're about to move, about to sign a discharge authority. You're happy to do it, of course, but just wanted to do that final check. Now, sometimes the retention team can give you an interest rate discount approval right there and then. Other times they're going to say, look, leave it with us, we'll call you back within 48 hours or something, and they'll go and seek higher approval for a discount. But that's really the fastest way in order to get the best deal. But of course, if they don't come to the party and continue to charge you a higher interest rate, then really you've got to talk to a lender or a broker about refinancing. Now, I think this is really timely advice because lots of borrowers fixed their interest rate over 2020 and 2021 when the banks were offering fixed interest rates for 2 or 3 years that were below 2%. And that's when the RBA had their special facility that were lending to banks at 0.1% for 3 years. And that's what drove all those low fixed rates. Now, it was just a way for the central bank to help borrowers get through the COVID period. But the point is that those fixed rates will start maturing possibly towards the end of this calendar year and certainly throughout 2023. So when your fixed rate matures, you've got the option to roll over to variable or refix for enter another fixed rate period. At the moment, fixed rates are not even close to being attractive. Now, they might come down over the next period of time, who knows? But at the moment, if you had a fixed rate that was expiring, you would almost certainly go to variable. And so the problem then, or the challenge then, is going to be making sure that if you're going to switch over to variable, that you're maximising your interest rate discount, as I've been talking about through this podcast. So at that stage, you're going to have to do that research or get your broker to do it for you to make sure you go and negotiate the highest interest rate discount that you can. Now, there's going to be a lot of borrowers in this circumstance, so I think the banks are going to be well prepared to retain customers as they come off these fixed rates. So knowledge is power, making sure you understand what's being offered in the market to retain your business, to maximise the discount, minimise the interest rate is going to be critical during that period of time. So anyway, I thought it was a timely reminder, particularly as we're experiencing higher and higher discounts for new borrowers, that just like with lots of different things, it pays to shop around periodically to make sure that you're not paying any more than the market rate. And that is certainly true with mortgages and even becoming more important than what it was, say, 10 years ago. So good to make sure that your mortgage broker is doing the right thing by you and reviewing your mortgages and making sure you have a competitive deal. Okay, that's it for this week. Until next week. Bye for now.